Hey everyone, Mo is here from Wall Street from Main Street, and today's guest, the returning guest, is Jerry Robinson. He's the economist, he's an investor, he's also a trader, he's also the editor of Follow the Money. Jerry, welcome back.
Hey, great to be here with you, Mo. I sure do enjoyed coming on the program with you.
Oh yeah, same here. And we have a lot to talk about today. Today in the news, the Federal Reserve announced they increased the interest rate for the third time in a decade, only 25 basis points, which is not much if you compare to what they did back in the 70s when they had Volcker. I just want to get your thoughts on that.
Yeah, well, it was pretty much what we had expected. The Fed had pretty much all but said that it was going to do this. I think there was a little bit of chatter in the market that we might see a larger rate hike than we got. There was a little bit of chatter that we would see a 50 basis point move. And predominantly because just prior to the announcement in the policy meeting, there was a lot of talk about how there may be even an acceleration of rate hikes. I think when you take a look at the CPI and you see the rate of inflation, we've been seeing it translate into commodity prices, and we're also seeing it, of course, just in the regular CPI, whether you agree with those numbers or not, at least the government numbers, you'll see them that they are rising. So, we're up to a 2.5% CPI, U.S. inflation rate, and the Fed is realizing that, it has really been sitting on its hands for a very long time. So I think you can build the case that the Fed has waited, entirely too long and that they're going to be playing catch up from here. I think there's a really solid case for that. Because we believe that the Fed should have been doing this a long time ago. The rates have been so low for so long that the distortions that have taken place in the market have been very great, and they'll continue to have reverberations for many years.
Yeah, I've been saying for the past 5 years that the Federal Reserve need to increase the interest rate, even though the pain in the short term will be very painful, in the long term will be better off because it'll clean out the any disease, so to speak, that we have in the economy and rebuild it from the ground up. And also it will create saving, and when we have saving, it will create capital and more jobs, and et cetera.
It will, but I think, also you have that, kind of a double-edged, you have a double-edged sword where those rising rates, those are going to begin to put pressure on corporate profits. I mean, during this last span of this period of low interest rates that we've seen over the last decade, many companies have survived and thrived through taking on massive amounts of debt. And now that interest rates are rising, that's going to begin showing up in the financial reports every quarter. And so if we do have an aggressive rate hike, those corporate balance sheets and those financial statements are going to start reflecting that. And so many of these over-leveraged companies are going to be, getting hurt for sure, as will over-leveraged consumers, over-leveraged business, and an over-leveraged government.
So let's talk about the market reaction to the Fed hike in the rates. So the announcement came in the afternoon, and we saw a positive reaction by the market. Were you surprised by that?
Well, perhaps. I mean, I think that this was kind of baked into the cake. It seemed that investors really liked not just the 25 basis point hike, but also the guidance, which was important and vital, because it wasn't just the rate hike. It was, it's more than that. The guidance along with it that they give, the policy statement that's issued, the words that are left in, the words that are left out. It's a bit of alchemy or whatever we call it. But but really, the Federal Reserve goosed the market again by really withholding for such a very, very, very long time, and then just simply giving a quarter point. We'll just have to see if they're going to remain aggressive. But when you take a look at the overall stock market, we're sitting just below. If you take a look at the S&P 500, for example, which is my favorite index for just kind of getting a broad idea of the market here in the United States. You have a top of about 2,400, and we're sitting at about 2,385 with tremendous amounts of support at about 2,364. And it's very possible we could break out here. but we are kind of looming underneath the ceiling that was reached several days ago, and we still have a lot of political issues, a lot of political concerns. We have the debt ceiling issue. We have, it looks like we dodged a bullet with the Eurozone elections. It looks like, at least with the Dutch elections, the latest I've seen is that Geert Wilders did not actually win the Dutch election, which, you know, that would have been pretty dramatic, I think, for the markets.
Yeah, he's kind of like the Dutch version of Donald Trump over there. That's what people are saying. I don't think he's that exactly like him, but they have similar policies in similar areas. But yeah, and the market had been completely overbought before we had that little pullback. When the S&P was at 2,400, we saw a little pullback there, and it touched the 25-day moving average, and looked like it's starting to bounce up. Do you think this small correction is satisfying, or do you think we need a heavier correction? Because at one point, the market was going up 11 or 12 days in a row.
Yeah. See, that's the problem. I mean, we had a really, really nice breakout, of course, on the election day, or not election, you know, but on the on election day, and then you have this really nice breakout, and it was huge volume, and it continued on for some time, but we have not pulled back to the 50-day moving average, and that's a real typical place to come back and rest, as you know, and we haven't seen that. In fact, we've just seen this market very extended, so. We're almost of the opinion that because we've run so far so fast that we could be in for a very gyrating market. That's why we're beginning to go long on volatility. We took a very little exposure this week with the anticipation, with a longer-term view this year, because it certainly seems that this huge uptrend that we've had is likely going to be mirrored perhaps in a vicious downturn, followed by perhaps another massive upturn. I think we might be in a very buoyant kind of market that could be very violent but also very lucrative.
Yeah, and there's a lot of external factors that could potentially bring the market down. There's the debt ceiling that you mentioned. There's the budget, the Obamacare. There's the an ongoing Cold War sort of between the U.S. and Russia. So there's a lot of factors that could potentially break the market. But overall, the market is overvalued. There's a lot of valuation analysts saying that the market is overvalued by as much as 30%, and it's even worse than what we've seen in 2008 in the dot-com bubble. So what's your take on that?
Well, I mean, you know, I cut my teeth on the dot-com bubble. That's when I first started trading, and so when I think back at those days, I am reminiscent of those days when I'm trading today. In fact, it really has not been until 2017 that I have begun to feel that same exuberance that I felt back in the late 90s. I mean, it's beginning to feel that way, and it's almost as if the anticipation and the exuberance surrounding Donald Trump and the future policies that he seeks to implement, including, you know, very generous tax cuts and you know, some sort of infrastructure spending. I mean, you know, these are all, and of course the deregulation agenda. I mean, we've seen some of this, but at the same time, we also haven't. We've also seen a lot of gridlock. So it's possible that the market has just gotten a little too far ahead of itself. I do think, though, that on any kind of pullback here, as long as it's not too violent, as long as we don't see just a total, you know, implosion of the uptrend due to some black swan, I'm talking about a normal general pullback, it could be a very good buying opportunity, you know, for investors who have been on the sidelines during this epic rally.
Are you finding it harder to go long on stock now with the stock market in general being overvalued? Are you going more short than long nowadays? Or what's your take on that?
Well, I mean, we never fight the tape, and so we're not fighting the trend. You know, the trend is up clearly, and so as I mentioned, I began buying some volatility options, but I'm scaling in. So I maybe bought 1/10 of what I plan to buy, and they're for long-term purposes. So that's the only short position I currently have. I mean, everything else, that I have now is mainly long. We're using a lot of leveraged ETFs in this environment. One of the ones that just hasn't done as well as we had hoped were small cap stocks. They've kind of lagged the market overall. We had high hopes for those with Donald Trump. But so far, they haven't run. So that's actually kind of a good thing. That might be an opportunity. If they're just lagging now, they might catch up eventually. Although the ETF we would typically use for that one is TNA, which is the let me see, I forget which one that is, who actually puts that one out. It is
small cap, 3-time leverage.
Yes, that's the one. Yeah, and it covers all the small caps, and that's the one that we use a lot for small caps. But we haven't seen a lot of action in that one compared to some of the other ones, and so we do use a lot of leveraged ETF for trading. But we also like to use just general ETFs, and for getting access to global markets. One of the biggest markets we played recently was Peru, and we've also seen breakouts in all across Europe. We've been seeing breakouts ever since December. We've seen breakouts in Poland and Netherlands and Spain. We called all of those markets back in December. And then we've seen other ones such as, Brazil also breaking out. So, there's been quite a bit of profit made, not just here in the United States, but also globally. But, for example, Peru, which broke out back in February of 2016, we just locked in a 50-plus gain on that one. But at some point during that rally, it was up, 80, 90%. And so, for average investors out there, getting exposure to the U.S. market is good. It's, obviously the market that we all know. But for those of us who want to go global, ETFs make that very possible. And that's one of the things that we do is we provide our members with uptrend and downtrend alerts on about 40 different global market ETFs. So when Japan enters a new uptrend, you'll know it. Because we put out a weekend briefing that alerts you to any trends that are forming.
Yeah, I noticed you seem to. I could be wrong, but you seem to favor ETF more than stocks when you're trading. Is that true? Or is it because of volume? It's better there.
Well, I'll tell you what. We just had Jim Rogers on our program, and I asked him a similar question. I asked him if he used ETFs. And he said that he did because he was lazy. And I thought that was actually a very honest answer, is that ETFs are really kind of a lazy way to invest. There's no doubt about it. And the reason why it's lazy is because you don't really have to take on that single stock risk. You get that diversification by having exposure to many, stocks, which I think is just wise. I think it's wise for a trader too. But it does strip you of that element of that single stock that could just go up and explode. So it does take some of the excitement out. I don't just exclusively trade ETFs, but I think for the average trader, and I think for new traders especially, they're much, I don't want to use the word safe in regard to trading, but they're certainly much more perhaps predictable. And perhaps less volatile for a new trader.
So, do you have any, any sector that you think people should be looking at, either to trade or invest for 2017? Anything you want to share?
Well, we got really bullish on solar stocks at the very beginning of the year, and we enjoyed a really nice rally in February. We've seen kind of a pullback there. We've been long on steel and copper miners since February of 2016, where we've been long water stocks since February of 2016. We really entered a lot of things at the very beginning of 2016 when they formed new uptrends. And we've been in a lot of those for some time. But we are seeing some general pressure in commodities now near term, and that's because we've seen this strength in the U.S. dollar with the Fed decision and all of this. So, and plus the anticipated future rate hikes. So that's going to put pressure on commodity prices at rising dollar. And so we're getting a little bit of a pullback. But we really like commodities underneath of President Trump. We like PACE. We refer to it as PACE. It's an acronym: precious metals, P, A for agriculture, C for commodities, and E for energy. And so that's one of the services we provide our members is the PACE report. And so we track all of these different commodities, and we really like commodities. Some select ones right now, as I mentioned, we're long on many of those. We like base metals. We like copper. We like uranium. We've been in uranium since December, and that's been a really good play so far. Lithium we got into in December of 2016. That one's doing fairly well. So those are some of the commodities we really like. And then as far as the global market, Europe has really been explosive. So we really have been enjoying the uptrends, as I mentioned, in Poland and Netherlands, and all of these countries are just a ticker away. I mean, you can get access to these with ETFs, and so that way you can provide yourself some diversification, so you're not just invested only in U.S. stocks, but you can have some exposure if you're so inclined.
So you mentioned energy, and let's talk about oil. Oil recently went below $50. A lot of people, after that happened, a lot of people came out and said it's going to go lower, it's going to go to 25, 35. So what's your thoughts on the oil market?
Yeah, taking a look here at a chart of oil, what I see here is, there's a lot of blood on this chart. I mean, there's just a lot of bloody outflow. I mean, it looks like there might be a short-term opportunity, but overall, I think what we've seen is, and this is just this week, we just saw the Saudi prince meet in the White House with President Trump, and you always want to pay attention to not what is said during the time, but actually what's said after. And after the meeting, the Saudi prince had said that the U.S. and the Saudis were basically hopeful of a reset in relations after a very tense relationship with President Obama. And so that bodes well in many ways for some of the tensions that were rising between the U.S. and Saudi Arabia. I think you have that. I think you have a rising dollar. But again, I'm not an expert on oil prices, so that's really probably where I'll end my comments. But I would say that right now, until we have a solid move above $50, I wouldn't be interested in oil. And I'm referring to West Texas Intermediate crude.
Yeah, I'm looking at the light sweet crude chart, and it broke the 200-day moving average. The volume was very high.
Big volume. Yeah, that's not a good sign.
Yeah. So it looked like it could go in a downtrend. So that's something to keep your eye on. And, oil is something that we're always going to need, no matter how bad the economy is. So oil stock would be a good investment for investors, for dividends or just for long-term play.
Yeah, I think that's something to think about, too, with commodities and commodity ETFs, is that commodities just don't go out of business. When we think about companies and single stocks, you can buy a stock and 10 years later that stock could have gone out of business and you lost all your money. It's rare that you'd put your money into a commodity ETF, for example, and lose your money over the course of a 10-year period, because commodities just don't go out of business. I mean, they just exist. And so we think that commodities provide investors with a very nice way to soup up their returns alongside, a good portfolio. These are all just additional or supplemental ideas.
Yeah, definitely. Oil stocks, and I think oil, gold, silver, and other commodities like uranium are probably the only sector that's undervalued right now. I think everything else is overvalued. If you look at the technology industry, for example, Snapchat, so much hype when that IPO came out, and that company's not even making any money. They're losing $100 million per year, and all these Wall Street analysts have a valuation of $15 to $20. I don't know how they come up with that when they're not even making any money.
Yeah, I know, and again, that's part of the reminiscent part of the late '90s, the Snapchat IPO, with the obvious deficiencies of a profitable company here. I mean, yeah, you have growth, but even though there was some questions, I mean, you're seeing it in the stock price now. I think right now we're very bullish. We use a sector rotation portfolio strategy that Meb Faber popularized. He put out a great white paper. People not familiar with Meb Faber can look him up, but he's got some really good work. He's done some really great, put out some really good PDF reports and white papers. But anyway, he put together a really nice sector rotation portfolio. We've been using that for some time now with all of our members. And right now, we are long financials, industrials, and technology. And when I say long, I should say we're heavy those. Those are the areas that we're really emphasizing. So financials, technology, and industrials, of course, those have been strong, but those have been strong for some time. So we've been in those for quite a while. And I think for people who are swing trading the markets, right now we're seeing technology and healthcare and even consumer staples kind of leading the way in kind of a mainly on the daily charts. But if you go longer term and you take a look at the really long-term view, technology, financial, and industrials have just led this market tremendously.
Yeah, and I put out a video about 6 months ago, and I was telling people that if they want an industry that they could short, not right now, but just trading ideas or research for any industry to short, I thought the retail restaurant industry would be a good place to start. And to look at all the data, and the data in that industry, it looked like the sales numbers are contracting and going down. So that's one industry I thought people could look at if they want to short anything. Do you have any shorting or trading ideas for shorting to share with us?
Well, as I mentioned, I just took on a very small position in volatility, so that would put me short the S&P. But that's a longer-term play, so I'm going out toward the end of the year on the expiration date on those. I'm expecting some sort of jerk, right. Some sort of moment this year. There's just plenty of landmines ahead for the market, and it does appear we're overextended. So I thought here, maybe I'll begin to add some volatility. So I'm certainly there. Real estate and energy have been the two that have been the most easy to pick on. Even though they're both all in longer-term uptrends, I would say real estate and even utilities to a certain extent. Utilities, although they've been in an uptrend for quite a long time, for example, XLU is the ETF that we buy for utilities. So we bought that one back at the very end of 2015, and it's up about 22%. But at the same time, it's just not growing the way you're seeing some of these other sectors grow. So I think utilities probably will continue to lag underneath the Trump sector. Don't you? I think you've even mentioned that before in the past. Utilities just kind of look dull here.
Yeah, I think that's one of the sectors that's a little overvalued, I think. So yeah, I agree with you. That's a industry people want to look at to short. Now, people have been asking me about trend trading. Can you use trend trading to trade options?
Oh, yeah. I mean, well, the way you would do it is you would simply, whenever you had a new uptrend or new downtrend form, then you could use options to take advantage of that. So sure, yeah, you could option trade trends.
Do you have a different strategy that you use when you do options compared to doing stocks?
No, the options, we have a lot of different strategies to use. We kind of got a wide toolbox because you can really do different things with options. You can certainly do, as you well know, I mean, you can certainly do earnings plays where, one of the most reliable ways to make money is through these, through the earnings plays with options. And then you can pick on certain stocks and just kind of hit them over and over. You can also certainly, use puts and calls. But we also have to look at that expiration date. And some people like to trade really close in. And in that case, you're kind of getting the exposure like a stock. If you trade a short-term option, it kind of trades like a stock with a similar volatility. If you trade a longer-term option, you may not get as much volatility. So it really all depends, on what you're wanting to do. But you can trade long-term trends with long-term options, and you can trade short-term trends with short-term options.
All right, great. So one final thing before I let you go. So you did a video talking about the biblical view on propaganda. Now, so what made you do that video? Was it all the fake news that's been coming out in the mainstream media, or was it just something else?
Well, that's what it was, that. And I think at the very, one of the big epiphanies I had, Mo, was in, of course, 9/11, 2001. And that moment shook me. That's whenever I kind of woke up and began my own, kind of search for what the heck is going on, in the world. How did all of this happen? And I really began a search, and it led me to an economics degree. It led me to, to writing a best-selling book. I mean, all of this stuff. And so as I look as I look at what's happening now, I certainly see propaganda, but propaganda is not properly understood. It's just not properly understood at all. Most people don't understand what propaganda is. They think they can see it. And that's exactly what propaganda is not designed. The propagandist administers the anesthetic so that the surgeon may operate without any public interference. So we go into a really good hour-long teaching on propaganda. People can view that for free on our website. You just go to Follow the Money, or I think it's ftmdaily.com/propaganda.
Yeah, and ever since Trump ran for president, I just think the amount of propaganda just kind of ramped up a lot. And since he came into office, we're just seeing a lot of, news that really not true, and stuff that just trying to twist it around and form their own narrative just to get people upset. So it was a good video. I definitely recommend people to check it out.
Oh, thank you very much.
All right. Well, Jerry, thank you for your time. If people want to find out more about your newsletter and your trading system, where can they go?
Yeah, they can just go to followthemoney.com. Just followthemoney.com, and when they go there, there's a tab that says shop or plans and pricing. Just click on that, and you'll see all of our different memberships. Whether you're just wanting to learn how to trade, or if you just want to receive a trading idea every day in your inbox, or if you want to get those uptrend alerts and downtrend alerts in your inbox every week, whatever you want, just go there and choose the plan that fits your needs, and we'll be happy to serve you. But thank you so much, Mo, for having me on. I always enjoy coming on.